Welcome back everyone to the Day Trading 101 mini course, part 2. In this video, what we'll be talking about is how to select good stocks for day trading, for momentum trading, how to find the best stocks, what indicators to look for, and of course we'll be going through some risk management like I mentioned in part 1 of the series. Again, my name is Wilson and you can follow me on Twitter at Wilson8. Please subscribe to the channel and give this video a thumbs up. So let's start off with going through the difference between a retail trader, versus a fund trader. So a fund trader is like a hedge fund, an ETF, somebody with a lot of money, right? So they're like private equity trading firms, they're financial firms, and they have a lot of money from different rich folks like athletes, investors, and stuff like that. What they're able to do is that they're able to buy and sell stocks that move in bigger price points. So for example, they will be buying like Tesla, Apple, stuff that gains like $2 to $3 a day, goes up and down. It could scale to above and beyond. Like Alibaba is a good example of a stock that they will be investing in. They can hold these positions for more days. These stocks are more stable. They're not going to go bankrupt on us like penny stocks. And they're able to just pretty much move the market by putting such a big trade in. But us as day traders or swing traders, we're considered individual traders. So we're a retail trader and we don't have that. We have smaller accounts, smaller capitals. So retail traders need to pick stocks that have quick momentum, huge spikes, lower floats, and high volume, which we'll go over later in this part of the course. Fund traders can pick stocks that are more safe, and they can pick more growth stocks, as I mentioned. Fund traders can hold stocks longer, and us as retail traders, we need to move quick. We need to identify the breakouts and profit from there, even if it's like 20 cents, but if we're holding a strong enough position, such as like 3,000, 4,000 stocks, we're able to do well because we're able to catch that breakout for that huge spike. So one of the biggest indicator, and it's a must have, is as a retail trader, you must find high volume stocks. So stocks that are trading with volume. We went over in part 1 what volume is, but it's pretty much the amount of shares that are being traded in the market. So it could be selling or buying, but it adds up to the overall volume. And this is super important because if the stock doesn't have volume, it's not going to move. A penny stock will be stuck at 20 cents or it will be stuck at 50 cents, and the whole entire week you might only see 2 or 3 cents worth of movement. So we don't want to get in position with those stocks. We have limited capital. We don't want to waste a week trying to swing that specific stock. So we need to find stuff that has high volume. Now the downside of high volume is that it can go either way. So the stock can go up or it can go down, right? It can go up rapidly and it can drop down rapidly. So you can lose your entire investment right away. But these are stocks we're looking for, and ideally we're looking for an upward trend and we're buying into a stock for the profit, right? So when it comes to volume, we want to have a strong relative volume of at least 2 or 2.5. A lot of stock screeners allow you to do this. You can put in the relative volume. Finviz.com is probably one of the best ones for you to filter out the different types of stocks in the market based on the relative volume. So a good example of what does a relative volume of 2 mean is that, let's say the average volume of a stock is trading at around 500K, so 500,000 is the average volume. Then the trading volume for that day should be like 1 mil or something along the lines of that, 1.5 mil, and that will represent 2 to 2.5x of relative volume. So always look for stocks that are high volume. I've made that mistake and thought a stock would do well. I had all my mindset on it and there was no volume. It wasn't going anywhere. So I ended up holding that stock for too long and it just wasn't worth it. So remember, as day trader, we want to profit quick daily or at least within 2 days, even if you're swinging. The second indicator is always look for a catalyst. So what is a catalyst? It's something that will spike the stock up. This could be an earnings report, just a strong reason, like a press release for the stock to go up, some sort of company news release, like they had a new partnership, they have some sort of buyout, they have some sort of merger, or they signed a new contract, some FDA got approved because of some, like bio stocks, healthcare stocks, they're always going through trials, and something got approved and it's on the news. This will spike the stock up, and it will give it volume because people believe in the stock, right? So always, this is the first indicator I actually look for, and this is what I look for in pre-market. When I'm before the stock market opens, I go on different news sites like MarketWatch, CNBC, The Street, Yahoo Finance, and I look to see what are the news that's coming out, because a bad news can drop the stock. So that could be a shorting opportunity for people who are looking to go against it. But ideally, I'm always looking for buying potentials. So some sort of catalyst will allow me to feel more confident. Now, that's just fundamentals. So news itself is not enough. But catalyst is probably the first indicator that I look for. Now, the second thing that I always look for after the fundamentals is technical analysts, right? Technical flows. So a good criteria for choosing a good stock with a good technical indicator is probably using something like I mentioned, like a catalyst. Never trade or buy the stock just because it's trending, right? We see a lot of trending stocks all over the place. Somebody like Jim Cramer or some famous analyst would recommend a stock and it'll be trending, but there's no actual news on the stock that will make it jump. And I want to trade the spikes. I want my biggest profit margin possible. But another good technical indicator is when it's very low in float. So something under $100 million, $100 million in float, and or ideally, what I try to look for is something under 20 million. The downside about looking at float is that there's not that many platforms or stock screeners out there that will provide you with a float number, and a lot of stocks that are actually jumping or penny stocks, they don't even have the float amount out there for public to view. So that makes it a little bit more difficult. Again, it goes back to using something like Finviz, which is a site that does show the float, but ideally I'm looking for something in the 10 to 30 million range for float. So that's the second indicator I always look for, something with low float, because it means that high volume and low float means it will move the price quickly, and when people buy like 100,000 shares or something, it will spike it, like it will push it up quickly, it will move the price quickly, and that's what we want. We don't want to compete with the fund traders, right? So the third criteria, of course, as I mentioned earlier, is the high volume. So low float, high volume, and ideally, I also like to look at the charts. I always look at the charts. I look for trends. I look for what's the resistance point, the support, and I like to look for something that has spiked at least 2 times before in its past. That allows me to kind of look at when was the last spike and when the next one will come, right? The last thing I look for is a strong daily chart that doesn't have too much resistance. So I don't like to see it going up and down within the like 3 or 5 cent changes, especially for the small cap stocks. I like to look for stuff that's been trending upwards, downwards, upwards, downwards, because what that means is that there's not that much resistance and the price is moving. There's liquidity. What I like to do when it comes to picking stocks is watching earnings. Earnings can break or miss a stock, right? It can cause it to spike, as I mentioned, is a good catalyst, or it can crush the stock. Well, I'll show you a couple examples of how that works in the next few slides. But earning can occur pre-market or it can occur post-market. The best way to do this is to use something like Benzinga or like NASDAQ to watch the earning calendar and see which companies are reporting their earnings. It will also show if it's reporting pre-market or post-market. I never ever buy the stock before the earnings is released because that's like a gamble. if it goes your way, sure, it can spike up like 5x, but we don't want to play those risks, because if the company reports a certain earning that's terrible from the estimates, then it can drop the price like crazy. So I like to wait for the earnings to be released first, and I like to watch it maybe for 30 minutes to 1 hour, maybe 2 hours after the market opens, after the earning is released, to see which direction is going. And that way you can kind of predict and gauge how the market is going to move for this specific stock. There's also, it could be like breakout news in the midday. So even though most of the volume trades really strong in the first 1 hour and 30 minutes of when the market opens, you could somehow get a breakout news in midday, or Donald Trump approve some sort of law, or restrict some sort of crap, and it will make the stock crush. For example, last week, Donald Trump put out some sort of act, and that made one of my stocks literally had a dip midday, a strong dip. Luckily, it came back up slowly, but this is also why we always have good stop loss to prevent us from these unfortunate events from happening, which I'll go over later on in the risk management slide. But we always want to look at earnings. We want to look for like new product releases, new company mergers, and especially how well they're doing as a company in general. Are they profitable, or are they improving every year over year? Because that's a strong buy signal. So make sure you do your news scan. I mean, even if you don't have too much time, at least spend like 10 to 30 minutes just before the market opens and see what's the latest news out there, especially with the earning stocks. I like to keep a watch list of all the companies that are having earnings that day or the day before, and then seeing what's the outcome. Then I like to look at the pre-market movements to see how it's going. So here's an example of an earnings spike. I mean, if there's a bottom dip, and then right before earnings, look at the volume. This is an indicator of the historical volume, right? The volume jumps. That means people are buying into the stock, and that's what we want. We want volume because it will move the stock price. So this is an example of a technical chart that just shows how the volume spiked up when it was earnings. Now here's an example of a stock that had a news spike, and news was released for this specific stock that officers, like police officers, might be required to wear this company's product. The stock went from $2 to $20 in like one trading day. That is insane. Imagine if you only had like 150 shares in this, or like 100 shares, you would have easily made like $18 per share, right? And that's in one trading day. This stock has this shows the power of low float, because this stock actually has really low float, and the volume wasn't that strong throughout their months. But as soon as this news was released that police officers and law enforcers might use their product, it might be a mandatory requirement for them to use it. It jumped up in one day, and this is the power of low float stocks. When volume goes up because of a news, plus the stock is already low float, this will spike the price up. So this is the stocks we're looking for. We're looking for these type of breakouts. So this is what you need to consider when it comes to stock selection. You have to look at the news, you have to read the news, and you have to listen in to see what's going on. So let's talk about some basic risk management. No matter what you get to, as I mentioned in part 1, risk management is the most important thing, and it's what makes a good trader different from a bad trader. It's what makes good traders profitable, and that's why 90% of traders fail, because they don't have good risk management strategy planned out. As I mentioned in part 1, I gave an example about like starting a business. You have to know your profit margins. You have to know if your company's going to be making money. And this is exactly how it is in trading. You have to have a good risk management. Like a mistake that I made, especially in my earlier days of trading, is I tell myself, hey, if the stock, let's say I bought in at $3, And if the stock drops to 250, I'm gonna get out. Then it drops to 250 and I'm like, I think it'll come back up. Let's wait a little bit more. Then it drops to 220 and I'm like, just a little bit. I'm sure it'll come back up. And then it drops to $2. Now, I exited at $2, but that's a $1 loss when I said I was gonna exit at 50 cents, at a 50-cent loss. So that's just bad risk management, and it's hard to overcome. It's a psychology kind of thing, it's a mindset, but you have to have that strategy in place, and you have to put that into your strategy when it comes to trading. That's the only way to be profitable, because you're not, no matter how good you are, no matter how good you are in technical analysis, no matter how good you are at stock selection, if you don't have a good risk management, you're going to fail, because not all the stocks is going to work out in your favor, right? So what I like to do when it comes to risk management is have a 2-to-1 profit ratio. So what does this mean? Back to that example at first. I bought a stock at $3. 2-to-1 means that I'm looking to exit anything above $4. And my one risk is 50 cents. So I want to double it. I want to make sure that every 50 cents that I put in, I can make back double that. So if I risk 50 cents, I need to be able to make back that dollar in general, right? I need to make sure it goes back up and not just risk 50 cents to make 50 cents, right? I need to make $1 and it needs to be double. So one of the best ways to have a basic risk management strategy is to set stop loss, like stop limit, stop loss, when you're buying into a stock. So that's the first thing you should do. So let's say you made a purchase order of a certain amount of shares, then at $3, like I mentioned for the example, then set your stop loss at 250. And if it drops below that, if you don't let it go any lower. Set that stop loss ahead of time and make sure you get out early so you can manage your risk and your losses, right? So always trade stocks with huge potentials, but make sure you limit your risk and make sure you have the 2-to-1 profit ratio, because if you make 10 trades with 2-to-1 profit ratio and you have good stock selection, you have good analysts, all you have to do is hit like 50 to 60% win rate and you'll be up that day. So even if it's $1 that day, you'll be up. So the timing that you get in is very important, but it's not as important if you set your risk management strategy. And make sure you do this ahead of time. So here's a quick summary of this part 2. I didn't want to make it too long. If you need anything, you can make sure you visit back to part 1. But quick summary is that when it comes to stock selections, choosing a good stock is very important. When screening stocks, the main indicators to look for is strong news release, some sort of catalyst, press release, something along the lines of that. Have a reason to trade, just not because of it's trending or some analyst recommended it or some bank upgraded it. That's not a legitimate reason. It could be added to your amount of reasons, but you need more than that, right? So I don't like to trade stocks that have no historical event. I don't like to trade stocks that jumped out for no reason. If there's no news, I don't like to trade it, because I want to make sure I'm thinking as if I'm investing in this company. Don't think of it as trading. Think of it as you're investing in this company. Will you invest in the company where the stock spiked up with no news or nothing good? It doesn't really make sense, right? Like if a friend asks you to borrow money for no reason, you probably wouldn't lend it to them. The next indicator is make sure you always have a low flow stock. High volume is a must have. Look at the charts. Make sure the trending is good. There's not that many resistance. Is a high moving chart. The price point's always moving, and make sure you have that good risk management strategy, as I just mentioned in the previous slide. So next up in part 3, I will be going over how to set up your pre-market screeners so you can identify the best stocks to pick for that day. You don't need too much. You just need maybe 5 to 8 max of stocks on your watch list to do this. And I'll show you exactly how you can set up these screeners. I'll show you exactly how to look into it and read the trend lines. And I'll show you how to identify the breakout patterns. Like what does it look like when the stock is about to break out, so you can get in there in time and make those profits. I'll talk about actual stocks and show you examples of real trades, and then I'll also show you what's the best time for you to get in the stock and get out. There's a lot of strategies. For example, some people get in, and then when it goes all the way up to the top, they sell, but they don't sell all of the stocks that they put in. They only sell half, and then if it dips down, then they keep the profit that they sold, and then when it goes back up, then they still have enough in there. They can also buy back in, right? And this all happens, it could all happen so rapidly, like within an hour, but I'll go over that in part 3 in the next video. So if you enjoyed this video, part 2, please subscribe to my channel. Again, this is Wilson, and give this video a thumbs up. I really appreciate it. You can always follow me on Twitter at @iswilson8. Thank you guys for tuning in.